I had my mask on for a minute.
That was really funny. Okay, so I hit record.
So go ahead.
Okay.
Thank you.
And Greg's on with us too. Okay, so I'm going to use notes so that I don't get too rambly and off track. But we're so happy to be with you. And when we did this last time, it actually, you know, in some ways it feels like a different lifetime ago, and in some ways it feels like 15 minutes ago. It's been interesting to see how out of whack timeframes are in both business life and real life lately. So we actually last spoke to you, Jen, the last time we did this conference call was on March 30th. And so our update from the firm, yeah, it's crazy, right? A month ago already, a month and a couple days. But our update here is that we've been at Gilman Hill. We've all been working from home since the middle of March, and that's gone astonishingly smoothly. Everyone's healthy, everyone's families are healthy, so cross our fingers and knock on wood on that. What we do is every winter, because as you all know, John Harrington runs a very tight ship. What we do every winter is we run a disaster recovery test. And so John basically has our IT guys pull the plug and make us pretend that we've just lost all of our systems to make sure that we can go on in that scenario. And we always make fun of him and we always, you know, poo-poo the whole thing and think it's ridiculous. But as it's turned out, it's been really, really helpful, because when we did decide on a Friday to not come back on Monday, doing that transition to working from home ended up being quite seamless for all of us. And we've been able to sustain it now for 2 months quite seamlessly. So starting last week, we actually did start to talk about plans to return. We have about almost 2,500 square feet in our office, so it's a pretty decent sized space. And our thoughts, just in case you're all curious, are that, well, so I don't know if you know this, but Jonna, Keith, and I have been working from the office every day since this started. And her family's totally isolated, my family's totally isolated. And then, you know, we kind of consider that our bubble. And then what we're thinking about is starting on May 15th, bringing one person in Monday, Tuesday, one in Wednesday, one in Friday, so that there's no more than 3 people in our big space, and putting in protocols for wiping down and all of that. And then starting June 1st, adding in one more person, so that there's four people in the space. For us, it would be really nice to get back to normal just from a social perspective. But I think the beauty of what we found with our business is that this business runs absolutely seamlessly and smoothly, even if we are working from home. So that's been a neat thing to learn. So anyway, I hope I should have led with this, and I'm so sorry. I just made the assumption that it was true. I hope that all of you are healthy and that your families are healthy. So, all right. So here we go. So since we spoke to you last a month ago, things are better and worse in a lot of ways. The economic impact of what's gone on is worse. When we spoke to you at the end of March, one of the things that we were talking about is how long will this last? And we were about 2 weeks into the social distancing and the shutdown of everything. And we were talking about, will this last 2 weeks? Will this last 6 weeks? Will it last 8 weeks? Well, here we are. We're at 8 weeks and we're just starting to come out of it. And I think we all know at this point that it is not going to have been 8 weeks and back to normal. It's going to be a slow, long haul. We've seen 30 million people lose their jobs. The first quarter GDP estimates came in, sorry, first quarter GDP numbers came in, and GDP was down 4.8%. These are huge numbers, you know, 30 million unemployed, negative 4.8% GDP. They're huge numbers, but they're not surprising. We love this economist, a strategist, an economist named Ed Yardeni. And what he said, which we've really latched onto, is that shocking, but not surprising. And that's been the key to a lot of this, is that the numbers we've seen have been shockingly huge, but they're not surprising. And as you know, investors in the market, we can handle a lot, but we can't handle surprises. So seeing these numbers in some way is actually not reassuring. That's not the right word, but it's useful, because with each bit of information and concrete information that we get, we can start to make real projections. We can start to see what 2020 might actually look like. We can start to bring the blurry future into a little bit more focus, and that's really helpful. We think that the worst is probably over in April, and that we'll start to see some gradual improvement in May. One of the really, really helpful things that's happened in the last 2 weeks has been that we've started to see actual corporate earnings come out. And as we've seen those, we've gotten more and more increased real numbers. Like last week, hold on, Greg, I hope I'm not front running your notes. Good, no, I'm not. So one of the things we saw last week was maybe this in the last 2 weeks, we saw Coca-Cola report, we saw Starbucks report earnings, we saw IBM and Verizon and AT&T and all these companies. But one of the cool things was seeing Starbucks report. And Starbucks obviously had a horrible March and a horrible April. Sales were lower than they've ever been there in terms of quarter over quarter or month over month decline. But they also said that by June 1st, they expect to have 90% of their stores open. So little bits of information like that are super, super helpful to us. Coke said that their volumes were down tremendously. Wait, Greg, will you correct me on this? I'm going to screw it up. Volumes were down tremendously, flat in March, down 25% in April, right?
Correct.
Yeah. But at least that's information that we can start to work with. Okay, so that's where we are. I'm going to turn it over to Greg right now just to run through some of the policy responses that we've seen and talk about what we've seen with the virus and cases, and then we'll get into the portfolio and what we're doing there. So, Greg, take it away.
All right. So a lot's happened since March 30th. As we started to talk about last month, was that there is an unprecedented policy response to the virus, and it's on several fronts. First, the most important front, I think, is is monetary policy. And the Fed, they announced over a month ago, they announced that they would enact unlimited bond buying to help stabilize financial markets. So over the last 6 weeks, they've bought $2.5 trillion of assets to help stabilize the financial market. So when you're seeing the stock prices have had a pretty sharp rebound since late March, that's probably the main reason why stocks have done so well in the last 6 weeks, is because the Fed is in there every day buying a few $100 billion of securities every week. On the fiscal side, there's a very big response as well. It's been a while. So over a month ago, the federal government passed the $2.2 trillion coronavirus relief bill. Then they added, about 10 days ago, they added another $500 billion to that bill for more funding for small businesses and hospitals. So it looks like the estimates right now are for that the total fiscal response is looking to be about 20% of GDP, at least. It could be even higher. So a massive response in terms of fiscal policy, something we've never seen before, dwarfing even what we saw in the financial crisis 10 years ago. There's also been a huge response in terms from the scientific community. We do weekly conference calls with Doug Gottlieb, who's the former head of Scott Gottlieb, yes.
Who's Doug?
He's a basketball analyst. Get them confused. Yeah, that would be more interesting. But Scott Gottlieb, the former head of the FDA, you may see him on CNBC every day or on the weekend talk shows. But we do conference calls with him every week, and gives us some really good insights of what's going on in terms of the scientific response to the virus. And testing, here's some of the progress we've seen over the last month. Testing, we went from testing about 200,000 people per week. Now we're up to 1.6 million people per week. And that's still not enough, but hopefully the progress continues and gets to a level where that's going to be one of the best ways to manage the virus is through more testing. We've seen great success in Korea and Germany, how they can use testing to control the spread of the virus. So hopefully we're on the same path as them. Treatments, last week was the FDA granted an emergency use authorization for Gilead's drug, remdesivir. This is a drug that showed some positive results in phase 3 clinical trials. It's certainly not a cure, but it does have some positive benefits and now is available for treatment. I think, while remdesivir may not be the cure we were all looking for, I think we should all be assured that there's more drugs in the pipeline. There are many drugs in phase 2 and phase 3 trials right now, and we're going to get a lot of data in the next few months from these drugs, and something is going to, each drug that comes out should be an improvement. We should find improvements on remdesivir and the potential for drugs working together in a cocktail that could help treat the virus. And then finally on vaccines, I did a lot of reading on vaccines this weekend, and there are 9 vaccines that have been identified as having strong potential. 6 of those are in, or either have started or are close to starting phase 2 trials. So they've moved along quite a bit. There's 3 that have potential, and if they're proved to be safe and effective, they could possibly get an emergency use authorization by September or October, according to Scott Gottlieb. And the interesting thing is, the normal process for developing a vaccine is to do the research, do phase 1 trials, do more research, do phase 2, then phase 3, see how that, analyze the results, modify, and then mass manufacture the virus. This one, they're doing things differently. With even before the drugs were in phase 2 trials, they're ramping up production. So, for example, the vaccine that's being studied by Moderna, they're working with a global partner. They're working on manufacturing capacity to manufacture 1 billion doses per year right now, even before it gets approval. So they're expecting to have mass manufacturing of the virus in July, well ahead of any phase 2 and phase 3 data from the drug. So hopefully one of these will be successful, but that still, at best, would start to be used in the fall. And so we still have to get to the fall.
Mm-hmm.
The good news on the virus is that it has plateaued in the U.S. We're seeing sharp declines in the U.S. in New York, and the rest of the country, it's more of a plateau and small decline in certain states. But it looks like we're past the peak in the U.S. for most of the states in the United States. Europe is in a continued decline. Asia, there are some spots where the virus is popping up, but China and Korea have seen very limited number of cases, so the worst is behind them as well. So overall, we're seeing the slowdown in the spread of the virus due to the mitigation tactics that have been enacted. But mostly in the U.S., it's outside the U.S., it's still a little concerning that the number of cases is not falling yet. But hopefully, greater treatments and continued social distancing practices will keep the virus under control until a vaccine or a treatment is developed. The reopening of the economy is happening. Many states lifted their restrictions last week, including Texas was the biggest of them. Florida lifted some of their restrictions today. All states seem to be talking about their reopening plans. Some will come later, but the CDC has put out some pretty good guidelines of what states need to do before they start relaxing the restrictions. We look to Asia and Europe as examples so we can learn from their experiences. They're about, Europe is about two weeks ahead of us in terms of the timeline of the spread of the virus. So we can see they've been reopening their economies for the last 2 weeks, so we can learn from their examples what works, what doesn't. What we're seeing from Europe is that even though you relax restrictions, people are still very cautious and they still practice social distancing. They're reluctant to return to retail locations. So there is a limited impact on the economy. The economies are improving, but there's also not enough activity where they're too worried about the virus, an acceleration of the number of cases in the virus from Europe. So hopefully we follow a similar path in the U.S. So there was a lot has happened in the last month, and I would expect that next month, the month of May, will probably be as busy.
Yeah. Yep. Okay. So I'm actually going to jump in with something that's off track for a sec, which is one of the questions that I've been getting a lot over the past 2 weeks is, what if this, or when this returns in the fall, is it going to be like a really severe double dip? Are we going to derail at that point? Will it be a whole nother flood of businesses collapsing, and will we be able to handle the economic shutdown if and when this returns in the fall? And I've been getting that, I don't know, maybe like half of the clients I speak to, that conversation comes up. So of course it's something that we've been thinking about, talking about, and working on a lot again. I think the important thing to remember, and Greg, please chime in too if you want to on this, but I think the important thing to remember is, well, first of all, I don't think it's a question that we will see a flare up in the fall. In fact, I've even heard that some of the schools are thinking about opening earlier with the anticipation that kids could get sent home in the fall for some time. But I think what's important to remember is when it does come back up in the fall, it's going to be a very, very different set of, I don't know what the right word is, a set of parameters around what's happening. When this started in February and January here, nobody knew what it was. So people were going into their doctor's offices, coughing away, particularly in Queens and the Bronx, where it's been the worst, coughing away, sitting in a cramped office and just spreading it like crazy. This time, people are going to know what that means. There's already increasingly useful therapeutic drugs. Like Greg discussed, there might be trial vaccines or vaccines that can be deployed at that point, even if they're not approved. I think that we'll still be wearing masks in a lot of places in the fall. We might be wearing gloves. The travel will be different. There'll be a different sensibility. So when it does come back up in the fall, I don't think that there's any logical reason to expect the same degree of fear, terror, economic distress this time around. Even if you just think of Gilman Hill as a microcosm, we'll know exactly how to deal with it this next time. We'll know that we should send people home with their chairs and their extra monitor and have them plan to stay home for a month versus thinking like, oh, we'll be back in 2 weeks. So I think we need to remember that when it comes back, there will be a whole different level of preparedness. Okay, now jumping onto the portfolio. One of the things that's been very challenging for us, and we've written about this a few times in our weekly or biweekly letters, and hopefully you're all getting all those. If you're not, for any reason, just email me or Jen or Greg, and we'll make sure that you're on the distribution list for the notes that we send out. Is that it feels very much like a tale of two markets. So as of Friday, we've got the S&P 500 that's down about 12%, and that feels like a very poor reflection of what's actually going on in the world and the economy and business in general. I think we've always thought of the market, or the S&P 500 as something that's supposed to reflect U.S. business, and in fact, it doesn't. And Greg, again, correct me if I'm off on this, but it's something like the top 5 companies, which are like Facebook, Apple, Amazon, Netflix, Google, maybe Microsoft, maybe not Facebook. They make up something like 21% of the weight of the S&P 500. So when we see the S&P only down a little, it's a very poor reflection of the overall U.S. business climate. I think what might be better to look at is an equal weighted S&P 500. So every company has the same weight. That is down 20%, not just shy of 20%. The Russell 2000, another index that's 2,000 small companies, that's down 24%. And the international indexes are down 18%. And I think those are more fair reflections of what real global and US business looks like and is doing. So I would warn you not to get too unnerved by the S&P and saying like, oh, the market's not accounting for this. One part of the market that involves some disproportionately huge and frankly, reasonably immune to what's going on, maybe even benefiting from in terms of Amazon and Twitter. Well, Twitter's not one of the big ones, but Amazon and Netflix and Google are in some ways even benefiting from this. So don't get too unnerved by that disparity. As you know, in our portfolio, we've been on the other side of that, where the bad side of that, where our portfolio has suffered way worse than the market. What was interesting for us was to see, in fact, April was a quite decent month, and we outperformed the S&P 500. So it's nice to see us starting to catch up, and maybe a little bit of rationality coming back into the market. So, and again, the market not just being the S&P 500, the whole investable universe. So for our portfolio, you've probably seen a ton of trades in your portfolio, more than I usually do. And the reason for that is that I'm extremely wary and careful right now not to be left out of the market overall. And it's not the FOMO, it's not the fear of missing out, but what we've seen is that the moves in the market have been vicious on the downside and vicious on the upside. And as a historian of the market and as a historian of investing, what we know is that if you miss out on the 10 best days in the market over a decade, you have significantly lower performance than if you had just stayed invested all along. If you miss out on the 40 best days, your return would have been about a third of what the overall market had been if you just stayed invested. So with these vicious moves, it's very important that we not miss out on the big up days, and we do not know when they're coming. Like last week, Monday and Tuesday were huge up days. We've had a few days where we've been up 5 and 7% in single days. If we miss out on those, we could cause really like a decade's worth of damage. So I've been very, very careful about staying invested through this. So the reason for all these little trades is that we're pairing up the positions that we want to get out of, and we've been using them as sources of cash, and then increasing the positions that we want to stay invested in. So for example, last week we increased our position in Umpqua, which is a bank that we bought in February. We wanted to wait for the earnings call, wanted to hear it from the horse's mouth that they were absolutely standing behind that dividend, which they did. We wanted to hear from management, even though we've spoken to them multiple times, that the business was in fine shape, that their loan book was in good shape, that the dividend was safe, that the cash flow was safe. So what we do is we wait for these, and then we increase the position in Umpqua, and we slowly work out of the positions that we don't want to hold anymore, which are going to be like Ford, GM, ultimately Targa, ultimately Six Flags is going to go, Covanta is going to go. And so this has created a lot of little kind of transitional trades. In the end, what I think is going to happen is that the portfolio will be smaller. Sorry, I should have said one other thing. There's been a ton of talk about dividends being under attack, right? Dividends are going to be lower. Dividends are going to be lower. The reality is this happened in 08, 09 too. Some companies cut their dividends. Some of the companies in our portfolio cut their dividends. This is the pits, but it is not insurmountable. And all we do is take it in stride and reposition. Historically, since 2001, our screen of investable companies, those companies with a dividend yield of 3.5% or higher, has ranged in about the 330 to 350 range. We look at those companies, we figure out which the very best are, and that's what we invest in. That whole universe is going to shrink a bit. So our portfolio will likely shrink a bit too. Historically, the portfolio has ranged between about 33 and 38 companies. We think going forward, it'll probably be 30, maybe 29 to 32 companies. So that'll shrink a little bit too. So what you'll see is we'll continue to work out of the laggards, increase our exposure to the winners, and over time, we'll probably add 2 to 3 new ones, resulting in a portfolio right now that I expect to be 30 companies. The yield on that portfolio right now is about 7.5%. We think that overall, the income should be very minimally affected once a whole transition period is done. It'll be a little lower than it was at the end of the year based on 12/31/19 numbers, but not too significantly. And it shouldn't for any of you have any real impact on your lifestyle or anything anything meaningful. It'll just be a transitional period. Because of the way dividends are paid, we don't expect the cash flow for the whole year to be meaningfully interrupted either. Even if you were to see the expected annual yield dip down for maybe a week or two, it should bounce back up within a few weeks after the transitions are more complete. So, okay, so just one other thing in the portfolio, we've had a lot of our companies report earnings. We've had some not so good, and we've had some phenomenal. So we've had excellent earnings reports so far from AbbVie, Dow, Verizon, IBM, AT&T, Pfizer. Just now, Hercules reported and reaffirmed their dividend. I'm trying to go through who else. B&G Foods, Enterprise, Navient, Compass Diversified. All of these companies have stood behind their dividends and reported like quite decent earnings reports in the face of this. We've also had some disappointments: Ford, GM, Six Flags, Ryman. But interestingly, we've had far more positives than negatives so far. So that's pretty reassuring. Okay, with that, I'm going to turn it over to Greg to get into specifics in the international portfolio as well as the growth portfolio, and then we'll open it up to questions. And sorry, I feel like I dragged on longer than I intended to, so sorry about that, everyone. Okay, Greg, take it away.
All right, I'll be quick. The growth portfolio, we've had a strong start to the quarter after a difficult first quarter. The portfolio is up just under 12% for the quarter to date. It's a pretty strong rebound being led by, we have a lot of exposure to the tech sector and healthcare sector. Those areas continue to perform well. Unfortunately, we do own Marriott and a few cyclical businesses that have exposure to the auto sector and aerospace industry. So we're still reevaluating those, and we may make some additional changes to the portfolio going forward to I think it's a good opportunity. There should be some opportunities to find some higher growth companies as companies are trading well off their highs. So we'll look to do that as the opportunities are created. In the international portfolio, it's lagged. International markets have lagged the U.S. in the last month. So we're up about 2.5% so far this quarter. The flexible dividend policies of international companies has allowed more international companies to maintain their dividends. We've had 3 dividend cuts so far. That's Las Vegas Sands, Kingfisher, and Royal Dutch Shell. We're working on selling those, and we should be able to replace those without losing significant income. Even right now, even including those dividend cuts, the yield on the portfolio is still 5.3%, and there should be a potential to add more to that yield as we replace those companies that cut their dividends. We are. I'm still optimistic on international markets. It's unusual that it hasn't rebounded as much as the U.S., given that the economy, especially in China, Korea, Germany, and several other countries, have been less impacted by the virus and should see better economic numbers and better earnings growth numbers coming from those companies. But so far, I think it's the power of the Fed buying lots of assets that's pushing up U.S. asset prices more than they are international prices. But that should normalize over time. So we expect to be patient, and we should be rewarded for continuing to hold. Do you want to open it up to questions?
Yeah, sounds good. Okay, I'm going to unmute everybody. Okay, everybody's unmuted. So please feel free to ask questions. Once a question's asked, I'll remute it just to keep down on background noise. But anybody got anything? Because I can fabricate questions if no one wants to ask them.
Kenny.
Yes.
This is Brian in Florida. Glad to hear that you're safe, dear. Glad to hear you're safe.
We are. Thank you, Brian.
Real quick, and you covered a lot as usual about the portfolio. Just an idea. As you've gone through this crisis, do you think it will open up maybe, or you'll look at different market sectors that you really weren't looking at before?
Yeah, that's an amazingly perfect question for today, like unbelievable question for today. So this is what's pretty cool about this. And I know I shouldn't be upbeat in this kind of environment, but I am. And what I was just emailing with one of my clients today is, well, the portfolio will be smaller. It's probably going to come out as one of the highest quality collections of companies that we've ever owned. So for example, I've never been able to invest in the insurance companies. They've never had enough yield, but they're clocked. They're down like 50%, all of them. And so what I did was I started looking at 2, Prudential and Principal Financial. But as you start looking at 2, you need to look at 6. And as you look at those 6, you find out that actually Unum, which is one that I'd heard of, but I didn't really pay attention to, is a remarkably stable company. And so I've been able to go back and look at this and see that even going back to 2007, this is a company that grew their revenues, grew their earnings, and never even cut their dividend, and grew their dividend from 2007 on. And so right now, as we speak, they're reporting earnings, and then tomorrow morning at 8 a.m. is the call. So yeah, I've never been able to invest in insurance companies, and I think we're going to be able to. Another company that we could never touch is Viacom. Viacom, as you may know, Viacom and CBS merged together, and they have incredible content. So even as we hear all these things about cord cutting, this and that, right? What's really valuable there is their content, and they own things like the whole Raiders of the Lost Ark franchise. So that's valuable. Meanwhile, the stock's got nearly a 7% dividend yield right now because all of the cable-related companies have just been tossed out. So this is what's, for the first 4 weeks, things were happening so quickly and so furiously with such little visibility that it was just scary, like just straight up scary. And then as we start to get real economic data and real scientific data and start to see corporate earnings, from there we could start to do our job and start to say like, oh, now I can invest in these that I've never been able to invest in. Now I can invest in those. And I might have mentioned this when we spoke on the 30th, but UPS is not quite there. But UPS might be something that we can invest in. If it weren't for an environment like this where the whole market is just thrown out or whole segments of the market are thrown out, I could never buy a company like UPS. With right now, it's got a 4.5% dividend yield on it and significant upside potential as we come out of this. So that's a perfect question. And that's kind of been what's the silver lining to all of this is that
Right.
It's fun to analyze companies that are really, really financially secure, but the share prices are just down so much. And that's where, when I say to people, the one thing I know for sure is that we will get back to past highs, and we'll start to grow again. The when of that, I don't know, but I have no doubt, right? I'd be an idiot actually to think that we weren't going to get back to past highs and then grow again, but I would be, right? To say we won't get back to where we were and then grow again, I'd be going against 100+ years of market history, and I'd be going against human nature to try and make a claim like that. So I don't know when, but I know we get there. So anyway,
Okay.
yeah, so it's fun to be able to start to do our job in a really constructive and exciting way. And that is the silver line of these rotten environments. So thanks for asking that one, Brian.
Thanks, Jenny. Appreciate it.
Thank you. Who else might have a question?
Well, I have an observation. I'd like to be as optimistic as I can be in a very difficult situation, but must admit to being a little rattled by an item that came across from the New York Times about noon, saying that the numbers that we should expect are going to be far worse than were anticipated. And I had thought we had turned the corner too, and they're saying no, we haven't, including Dr. Gottlieb. And I'm just worried that perhaps we're a little too optimistic about the direction, and in fact it's going to linger on a lot longer than we expected.
So
Did you see those numbers, Jenny?
no.
So they came out, and apparently it's a leak of a White House report that's gotten in the hands of the media, and they are even Scott Gottlieb commented them on Twitter about them, and no one knows really where these numbers came from, what the assumptions are behind the model, and the model has the number of cases of COVID increasing sharply towards the end of this month and in June, which would go against all the trends that have been in place. And unless they know something that we don't and all the other models know, that this would be really surprising. I was too shocked by because when you look at the models, it breaks a trend. Cases in the U.S. have been plateauing for several weeks now, and there's no reason to believe that trend would change in the relaxing. And if anything, there's a couple of forces that many experts believe. The combination of warmer weather, more humid conditions, more people being infected already, a little bit more herd immunity would help slow the spread of the virus. But this report supposedly leaked from the White House would go against that. So I would take the numbers with a grain of salt. We should get more details about what's behind the model. Of course, the media, they need to sell papers.
I guess I'd say two things in response to that, which is, shoot, what did I just do? Hold on. Okay. So I don't know if you remember this, Damon, but do you remember about a month ago, Trump came out and he said, maybe it was 6 weeks ago, and he said we expect between 100,000 and 240,000 deaths from this. And it was interesting because we've been listening to these Scott Gottlieb calls every week, and they've been really helpful. And when that came out, he said, I don't know what models they're using. My estimates are lower than that. My estimates are about 90,000 deaths in the US at that point, but I don't know what those models are. And then we went from that to doing a call with this economist who we like, this Ed Yardeni. He's really, really good. And I think we read something else, which was kind of saying something to the extent of epidemiologists are not dissimilar from economists. And it all depends on what their modeling technique is. And what Yardeni speculated, which we then heard reiterated, was we wondered if Trump didn't use those numbers to set a bar for himself to easily beat. So you could be like, oh, it was going to be 240,000, and look, it was only 100. How wonderfully I did. So I'm a little skeptical on any modeling numbers. That's I guess one part of it. The other thing is, I think what I've realized about myself and doing these calls and seeing myself actually like I can see myself, whereas usually you can see me, but I can't see you. I think what I realized about myself on video is that I come across as much more positive and upbeat than I feel on the inside. You know, I have like a cheery voice and a cheery face. And so I think when I say I know we'll get back to past growth and I know that we'll exceed that and I know that we'll be okay, that's not me intending to be overly optimistic or cheery. That's me stating fact based on market history. And I don't know how long that process is. I don't know if it's 18 months or 24 months. But I guess my point is I don't mean to come across as overly cheery or optimistic on that. Other than the fact that, like, you know, I need to look back to history and say, this is, I had another good point brewing in the back of my head for this too, and now I've lost track of it, so I apologize on that. But anyway, so on the optimism, don't let my cheery face distract you from my inner turmoil. Okay, Greg, did I leave something
I
out?
want to be
on
optimistic
the
too, but
modeling?
this one just did rattle me because it flew in the face of where I thought we were and the corners would turn, and it did reflect a much more sober picture.
Yeah.
But anyway, let's hope.
Are you looking, one of the, if you want, I can send you a couple of links. I look at one called worldometers.info. And Greg, what's the website for the other one that you shared with me?
COVIDtracking.net
Right.
or COVIDtracking.com. They're all good.
Have you taken a peek at either of those, Damon?
No.
Okay.
I'm not claiming any special knowledge here.
Yeah.
What struck me is that in that article, Dr. Gottlieb is quoted quite extensively. And he's not exactly optimistic in it either. So it raised my thought pattern as to whether or not it was going the way we thought it was.
Interesting.
I don't think there's anything you could say except that it's you know, we just have to keep our eye on that, I guess.
Yeah. That's funny because I watched him this morning and I called Greg and I said, oh, did you see him on the news this morning? And Greg said, no, but I read his comments. And I said, oh, I'd be curious if you watched it, because to me, Gottlieb this morning at least, I thought he was less, like usually I watch him and I'm like about to go start crying in a corner again. And this morning I felt more kind of hopeful than I had in a long time. And he was really focusing on the way that they deploy the use of the vaccines, whether even without them having been approved. But I thought he had a more upbeat manner. So I'm curious, like, I don't know. I'll definitely read that as soon as we get off.
His commentary, I think a lot of his commentary on this, I saw the article, was misconstrued, that where he's saying this is not good. I think he's talking about this is not a good model. Like the assumptions behind this are not, we don't know where they're coming from, as opposed to saying that this is, you know, this is going to happen and it's not good. We'll see. We'll get more details about it going forward, but it differs from all the other models that are out there, and I'd be shocked if there's anything but either a plateau or a small decline in the number of cases, not an acceleration. You know, this is showing an acceleration like we had in February, which would be highly unusual.
Yeah, interesting. That's part of the challenge of this
You
environment.
need to dominate the conversation.
Oh, no, it's fine. But it's just one of the challenges of the environment, which is like, if I'm listening to a conference call, I can miss momentous news. You know, things are happening within 15 and 20 minute increments nowadays. It's wild. All right, who else might have questions?
Jenny.
Yeah.
Can you hear me?
Yes.
Yeah. So with let's see, everything that you said before we went back to this topic is that despite the illness,
Yeah.
the companies that you own or will begin the ultimate portfolio that you end up with.
Yeah.
You're moving out of things that aren't doing what you need them to do and moving into things that are. And that's going to continue to happen, even, well, not if everyone, you know, certainly if this is a whole new flare up, but that is the confidence that.
Yeah.
I don't think you're being light, you know, you're being careless about being optimistic. You're saying the facts of the companies you believe in and that are going to pay your clients, our clients, dividends.
Right. And that's like listening to the IBM call, where IBM usually talks about the dividend and it's like a single sentence because it doesn't warrant anything more than a single sentence. You know, and on this call with IBM, you hear the CEO, I think 5 or 6 times, strongly state the dividend is a top priority. We have all the cash to cover it. Like, this is important to us. This is how we return value to shareholders. And by the way, we just earned $11.6 billion of free cash this quarter. Of course, we'll continue to pay out the dividend. So that's interesting. You know, and you're reminded of how resilient some of these companies are. And I know there can be a negative perspective on returning cash to shareholders, but I don't think there should be. To me, if you are an investor, you are putting your capital at risk, you know, and you should have return. And a dividend, to me, is the purest form of shareholder return, right? You're not banking on a story. You're not banking on other people's behavior to put money back in your pocket for having taken risk and invested. The company is paying you a dividend and the cash is going into your pocket. So it's interesting to listen to an IBM or an AT&T or a Verizon or frankly AbbVie. So AbbVie is the healthcare company that makes Humira, which is for rheumatoid arthritis. And it was so interesting because Andrew, our colleague, and I were both listening to this call at the same time. And Andrew wrote back, if it weren't for COVID, they would have smashed this quarter. And I wrote back, in my opinion, they did. And I've got my notes right here. So here's this quarter, you know, with all this stuff going on, and their revenues were up 10%. Their earnings were up 13%. And they said, we are strongly committed to continuing to grow the dividend and decrease debt. And, you know, and we're making enough cash flow to do that. Meanwhile, this is a company that put out to the public all the data, research, and science that they had behind any drugs that could help in the fight for COVID. They're like, look, we don't need to make money. We're just putting this out there to the scientific community so that everyone can build on it as much as they can. So that's the kind of stuff that I'm hearing. And then that's where I'm increasing our exposure to those kinds of companies, either by investing more or by letting them grow to larger parts of the portfolio. Yeah, and that's where I have confidence. Maybe not, you know, maybe not rah, everything's gonna be fine like 6 months or 2 months, but that's where I have confidence. Yeah, thanks for highlighting that. All right, anybody else?
I'm going to ask one quick question that I don't, just Greg, could Greg explain what the flexible dividend policy in international, what you mean by that?
So in the U.S., this goes back to a long history. The companies would pay a set amount for the dividend and then would continue to pay that and would try to improve on it. And it became a terrible event if a company had to go back and cut their dividend and make it lower than what they paid in the past. Overseas, most companies don't have that practice, and they pay out a portion of their earnings. So in good years, they'll set, a lot of companies will set a target that we're going to pay out half of our earnings, and if earnings are great, the dividend's high, and if earnings are not great, the dividend falls back a little bit. So there's less pressure to maintain the dividend, and as a result, I think the balance sheets were maybe in a little bit better shape, and there wasn't the need to cut the dividend to claw back, to retain money and liquidity to survive. So they could easily cut the dividend, a few pennies, just because they're making less and sustain it, as opposed to cutting the dividend completely in the U.S. It's just a little bit of a nuance between markets.
Yeah.
Yep.
Great question, Jen. I'm
All
surprised.
right. Thank you both.
Oh, you're so good. I'm surprised no one asked about energy, and what's going on there. So unless anyone cares, we can chat about that later. Or I think we wrote about it in one of our notes 2 weeks ago. So it's been interesting. Can I just say one thing on energy before I let you guys all go?
Yeah.
Okay. So what's been driving me cuckoo always, but particularly since this started, is how the price of oil is pinned to all energy related companies. As you all know, we own a lot of these pipeline companies. And the reality is for the companies that we own that have the pipelines that transport energy, it's mostly not oil that they transport. It's mostly natural gas that the companies that we own transport. And actually the price of natural gas has held up incredibly strongly through this. And that doesn't matter anyway, because they don't price off of that. They price off of the demand and what's going through the pipelines. And the demand, which is the key for natural gas, has remained incredibly stable and steady. So what's interesting is, even though some of the share prices of what we own have been damaged, what we own, depending on if you want K1s or no K1s, we own Enterprise, Magellan, Energy Transfer, or Kinder, ONEOK, Williams. All these companies have reported earnings, and they've been fantastic. And some of them have actually increased their distributions. So even as the price of oil went into negative territory 2 weeks ago, that was really a trading technicality. Even as that happened, many of the companies that we owned weren't just okay, but they were up, and they've been up quite significantly over the last month or so. So that's been a neat thing to watch play out. And you know, when all that was going down 2 weeks ago with the price of energy trading, all the market pundits were saying, like, mark your calendar, you know, take a picture of your screen. You're never going to see this happen again. I'm not sure that we are. One other interesting thing, I don't know if you all saw this, but the price of oil went to almost negative $40 a barrel, which meant that people were being paid to actually take the barrel of oil. Because the people trading it, they thought they were just trading, like, you know, like monopoly money. And then as it got closer to these options contracts maturing, they realized, oh my God, this is for real. I might need to actually own a barrel of oil, and I have no place to store it. Freaked out, started just trying to get rid of these contracts. It caused the price of oil to go negative. But what's pretty cool is a couple of the companies in our portfolio have been looking for areas that they can actually store that. So if it happens again in June, they can say, fine, you can pay me to take the oil off your hands. We'll fill up this pipe. We're going to empty out this pipeline. We can fill it up. We can use it as storage. And you're paying me to take your oil. And then when things recover to a more normal thing, then I can sell it. So not only will they get paid $40 to take the barrel of oil, but then they can sell it for $20 later. So it's been neat to see the companies that we invest in behave very opportunistically for this. And we'll see how it plays out. But so far, those companies in our portfolio have done extremely surprisingly well. So that's about it.
Great.
Okay. Thank you all so
I got to
much.
run.
Thank you.
Bye. So nice to see your faces and nice
Thank
to hear
you very much.
everybody's voices.
Appreciate it.
Thank you.
Bye, everybody.
Thank you.
Bye-bye.
When's your next CNBC?
Oh, like 5:30 a.m. on Thursday. So, and then I think I've got a normal time next week, but I can't remember. So,
Okay. Thank you.
you're welcome. We'll
Bye.
see you soon. Bye-bye, everyone.